refining, waste to value, all these different areas. So hopefully I can weave that in, and I'd love to follow up with you if I don't cover it today. So as Martha, I'm Carolyn Abramo. I'm the CEO and founder of Pana Low Carbon Economy Investments. Carbon is actually only 60% of our greenhouse gases, but it is the most prevalent. But we also look at the whole slate. So our thought process is a couple things. So my background, and as Marty said, is in traditional energy, and we have a team that we brought together that are really commodity infrastructure people. We've been operators of big infrastructure, not just in energy, but just across the spectrum in real estate, agriculture, metals and mining. And frankly, these are the biggest sectors that we need to decarbonize, and actually there's the most opportunity for growth. So we look at this as there's a huge TAM at the end of this. This is a huge market to invest in. You can actually trade carbon in the market now, which actually we talked a little bit about, which, my background, I actually started as a natural gas trader specifically. Natural gas derivatives trader at Bankers Trust. I was like, this is like going down memory lane.
It really is.
But the truth is that the genesis of those long-term traded markets, the ability to lock in a forward price for 20, 30 years is really the stability that has really anchored a lot of our industries, not just energy. But when I started in the mid-90s, it was the natural gas contract, the WTI contract, that had really just come to being, and that allowed me as a banker to be able to go lend a lot of money to energy companies. So we saw that with solar and wind, with long-term PPAs, and now we're seeing it with a carbon price. So if we can do that, and believe me, that ecosystem is well forming, and there's lots of opportunities to invest in platforms and invest in carbon itself. So really exciting. So you can tell I'm pretty passionate about it. But what I think is really most important is, as a team, that we do have that expertise in what exists today in terms of infrastructure. And actually, Marty coined the term rational actor. And I would say Pana is an absolute rational actor in what we can do today to reduce greenhouse gases that gets us to the 2050 Paris Accord goals. And the good news is that we've been incubating a lot of these technologies in an early stage venture forum within academia for decades. So we have a lot of things to choose from. So, it's not, it's pipeline. We have to go find all these things. We actually have commercially ready technologies. And when I say commercially ready, that means they could be deployed into large supply chains in real estate, energy, agriculture, metals, and mining, to just name some of the big ones. And the people that are buying those technologies are every corporation you can imagine. So, every S&P 500, every public company has to report their greenhouse gas emissions these days, scope 1 through 3. And they have put targets out in the market of how they're going to reduce them, especially those actors within real assets. So they're buying the technology. So we have a big shift now. It's not technology looking for a home, looking for a TAM. It's the other way around. It's the TAM looking for the technologies, which is great. So what we've done at Pana to develop, we have what we call the Pana network tool. So we're actually working with corporations, understanding their supply chains. Again, we're operators, so we understand them. What technologies do they need that they're going to buy? Maybe first step is going to partner in some equity checks, but then maybe into project, actually funding the next projects for that company. So that's actually happening. So a lot of capital, hundreds of billions, if not trillions, which is what we need, is actually going into this market. So I usually go on speaking after crypto folks, but I like to say, carbon is a huge, huge opportunity. So, no matter kind of where you come out in terms of the spectrum of like inclusivity, exclusivity in terms of divestiture, this is a big market. So we built this team to be able to take advantage of the opportunity. Not just are we commodity infrastructure operators, but we're fiduciaries. So we have investment experience over decades. So we've invested in private equity, we've invested in public companies, both public equity and debt. And frankly, that is some of the rationality that needs to come into this space, because it's fantastic. And this is a great group because I think it encompasses a lot of different investor interests, family offices. I have a personal interest. I actually, this is something I want to do well and do good. Or my assets are industrial assets, or I own farmland. Like, this is very, very personal for a lot of folks. And the reason why with earlier stage types of technologies or companies or impact areas, you need folks that are willing to de-risk some of them that, let's say, that there hasn't been a lot of exits or there hasn't been a lot of funds. There's no mechanism in a traditional asset management world to like actually get people started. So families are extremely important, but have interest, and potentially though, there may not be a framework. Maybe yes, maybe no. But what we will set out to do is to say, well, let's put all the investments on all of these subsectors together and come up with like two big criteria. A, return, so financial return, 25-30% IRRs. So we're very much in the growth equity piece of the puzzle in terms of investment, 2 to 3 times on return. So not the early stage venture, the 10x or the kind of maybe binary outcomes, but a de-risked piece of the investment pool. And we're before infrastructure. So we're before the most de-risked part of the capital stack, which is where all the money is. There's billions and billions literally sitting on the sidelines right now, waiting for these companies to get mature enough where their technology is commercially ready and that they're on project 6 and there is no technology risk and they're EBITDA positive. And it's like, okay, so we are in that middle piece as growth equity. And so we're filling gaps. And that's the big thing of where with Pana, we're fiduciaries, this is a financial proposition, but from a mission alignment perspective, in terms of impact, we're like, this is the piece that's not getting any capital. And there's a reason. There's know-how, and frankly, there just maybe not a way to actually understand what those risks are. So we've created a risk score. So not only do we have a Pana network tool, which links supply chains in the corporate supply chains with the technologies that would be most relevant for them, but we have a risk score that basically says this investment, we'll score it from 1 to 10, and here are the major risks: commodity risk, regulatory risk, execution risk, funding risk, and technology risk. And so we'll score our investments from that perspective, so that now we have kind of an apples to apples way of discussing it, amongst what would be enough on
environmental in that? Is that from a climate change standpoint? Because obviously
that's a good question, Peter. So we actually do carbon life cycle and carbon impact as a team. So I should mention, not only do we have the financial return hurdles, but we also have an impact hurdle. So our fund one will reduce a gigaton or more of GHGs with a heavy emphasis on carbon. Right. So the criteria for us, or the way that we prioritize the companies and the sectors, is that can they meet those two things? Can they have those? So that's how things kind of rise to the top that will be in our fund. Besides, everything then relates to a financial model, right, which we're very much, put forward in terms of, I heard revenue a lot here. Like basically all of our companies have some revenue. It might be $10 to $50 million, but they're selling their product. They're potentially into long-term contracts for 5-10 years, but it's a viable, it's a meat stack, and now it's just they have to get bigger. So
one of the things you didn't mention was like a capacity risk or a constraint risk. Obviously, like some of these solar companies, there's a lithium capacity or constraint risk that,
yep,
right? And some of the solutions you're talking about are ready to deploy, where they're not as constrained, right? So
exactly.
Can you differentiate between the two?
I sure can. So our first investment last year was in a company called Braven Environmental, which turns waste plastics, all the rigid plastics, into a clean fuel that could be sold straight into transportation, with exactly like ultra low sulfur diesel. That could be sold on the NYMEX. But they found the best market, which is the refinery corridor. So they sell directly to Chevron Phillips Chemical, Dow, Lyondell Sabic, literally like an endless sink of demand for this product that they can put through their refiners. But now that they've reduced the fossil fuel qualities of the fuel, it can now be reformulated and sent out to packaged goods companies. So big CPG companies that need this for, everything that we have is in a little plastic container. And now their mission is, with their GHG reductions, is that they need better materials. They need stuff that doesn't start with fossil fuels. So we can use waste plastics, which changing. This is called advanced recycling, not mechanical recycling, which I could talk about, but it actually changes the properties of the plastic. So that's one area, and we have a lot of waste right now. So we don't send our waste to Asia anymore. So it's actually just pooling on either on land in old grain elevators and literally storage facilities all over the US landfills or in our oceans. And it's actually, we're talking about health a lot. It's a huge health concern. So feedstock, we have a free feedstock for the most part. It's like people will be paying you to take their waste. So, Braven gets paid to take this waste, and they can convert it using an old technology, really pyrolysis, like a heating technology, and they can turn it into this clean fuel. And they literally they produce about 1 million gallons a year outside of Raleigh, North Carolina, and they need to produce about 100 million gallons a year, about 5 times, because they've sold forward 5 10-year contracts to those refiners that I've spoken to.
So they have off takers already on the product.
Yeah, and that's one of our huge commercially de-risking items as PANA that we look for, is that they have those commercial contracts in place. Another thing we really like about Braven is that it's really low capex. So they actually make mini refiners. It's about $20 million capex for these little refiners, which they can cluster together, and there can be efficiencies in terms of.
They're out of Raleigh, Durham?
Raleigh, North Carolina.
Uh-huh.
A little town called Zebulon.
And that's Braven, Braven.
Yep. And I think, and I gave
I have a slide of the. You want me to post it or?
Yeah, you can
Sure.
post it.
Okay.
And you can see how we run like Braven through our those risk scores that I mentioned, those 5 different risk scores. But a couple other things that we like about Braven: it's modular, so you're not building a mountaintop facility, which is pretty much the way we usually are. So they can go where the waste is, and they can go where the customers are, where the refiners are. So their next big footprint is in Texarkana. So very friendly environmental permitting, very good business environment. They're next to their customers, and so now it's the next 100 units. And so, for us, we got a company model from Braven. We can build this many units in this amount of time, this much capital, this is how long permit can take. And then we as PANA, we'll look through as a team, and we can take it line by line. Okay, here's where we think that, let's add about 2 years, to that estimate, here, let's add, actually where we're adding is on the green premium side of that. Very importantly for Braven, they're selling this product to refiners, and the refiners are paying like a 40% markup of what they would pay for a normal product, because they can sell it to these packaged goods companies for an additional revenue upside. And the great thing about packaged goods is that it's such a small percentage of total cost of goods sold that a consumer like us, we would never see that. So we don't feel like we're paying for it. So that's a very big issue thing that PANA is looking for, is that the company has good operating margins, and we don't depend on regulatory incentives, which is huge. And so in our risk score and the regulatory piece, that's how, and the colors are just, green means really low, like 1 to 3, yellow is like 4 to 6, and then there's no red. But why we did this is because we are asked many times to look at other people's portfolios, other companies, and then we run their companies through our risk score. And so that sometimes there is red, and so we'll say, like, this is how this would come out.
Can I give you 2 quick examples?
Yes.
Go ahead.
What's the energy input to energy output on this?
Meaning, so pyrolysis does have some energy, but the balances are negative. So meaning that, but.
So you get more energy coming out of it than going into.
Correct.
Right.
Correct.
Okay.
And the carbon reduction is quite massive. And so we modeled out the carbon reduction, as well as methane reduction, because you're taking material out of landfills, and landfills are huge.
What's the taxes? Are there tax incentives as well? Do you get tax credits on that in this process?
You could, if they sold their pyrolysis oil into California, they would get LCFS credits and RIN credits. Like there's a whole system of transportation fuel credits in California. So you may have heard of, turning cow poop into renewable natural gas. That's something that we look at, and it falls into our rational actor, moniker, because it's gas. It's renewable gas, but it's gas, and and it goes into the total gas stream. But if you sell it into California, you get some really massive credits, and it makes those opportunities really profitable. But the other thing we like with Braven, and it's not necessarily the case with RNG, renewable natural gas yet, although farming methane, cow poop is everywhere in the world. Yep. So this is highly scalable, but it's been very much fast forward to California because it's been the most profitable. What we like about Braven is that they can deploy their technology around the world. So we can scale, and because, global greenhouse gases are all around the world. So it really doesn't matter sometimes like what we're doing versus like China. It's like ultimately, we're all in this together. And a lot of the projects are the cheapest, the first ones are cheapest to be deployed into emerging economies.
Yeah, Africa, other countries.
Yeah. So you get a demo facility to prove it works in a large scale, because this is the whole game. It's really speed to market. If we can bring in corporations like, Chevron, BP, Anglo American, Glencore, I mean, Cargill, these are all the folks that we partner with. And if they can help to de-risk the opportunities, get projects done faster so that you can get the right data that can be communicated to the companies, that will speed up capital and frankly impact. We will get this stuff
It's
done.
good for the PR too. So
Yeah.
Cooper Company is nut jobs, bad name for the company, but there's 1 billion pounds of almond waste each
Yep.
year in California.
Yes.
So this company, we got a bunch of patents, they got funding, they make an alternative plastic products, basically. So it's biodegradable and others. And the other one, it's actually, if anybody remembers Dick Enberg, his daughter Emily, is taking the very large fishing nets in the ocean are made out of plastic. I didn't know that.
Yep.
So she's taking them, recycling them, making a kitchen, after going through a process, making kitchen towels out of that. So she's going to be launching later this year out of Germany and across the,
It's great.
Yeah.
And so I would say, this Braven is inclusive of our waste to value sector. And I sent Marty a slide that is it's not completely comprehensive of all of our sectors, but given the criteria we have for return, impact, and the risk characteristics of like getting a portfolio closer to 5 and not having any regulatory dependencies, having high operating margins, we've come up with sectors that we think are the most deployable in the most timely fashion we need today. But that doesn't mean that we don't look at the next sectors that would be potentially deployable. So we talked already about geothermal. That's hugely on our kind of next emerging technology and implementation type of opportunity, because it is baseload power. It works when it's not windy or sunny. It can be a battery. I call it Earth's battery.
Yeah.
There's literally thousands of abandoned greenfield geothermal sites that the big fossil fuel companies looked at years ago, and we're like, fossil fuels is better.
Yeah, we looked at that, but the baseload capacity was too low. So you'd have to pop a lot of holes in the ground for that and kind of tie it all together with the grid. So always promising technology. It's the Earth's inexpensive, but the baseload aspect was never there.
Well, now it's advanced because we've now gotten to where there's more companies that have adopted it again, or more big energy companies.
Good.
So we have a company ever that's in our pipeline, and we have probably a dozen or so that we're looking at.
Good.
But what I will mention too is that we look at this as building sectors. So Braven's just the first in the plastics. But we have 6 or 7 other plastics companies using pyrolysis, gasification. We look at other waste, nut waste. We look at organic waste. So in your landfill, you have inorganic, which is the plastics for the most part, and paper, used paper. And then you have organic, and the two don't work well together. And so organic can be used in all kinds of things. So we've done tons of work on a company called Anubia, which they can make a sustainable fertilizer out of organics, which is tremendous. And that organic property, when you put it back into the soil, will regenerate the soil. Because that's one thing with farming, is we farm the heck out of the world. So we get very low yields.
Right.
So that's another application of waste on the organic side. And there's literally should be dozens, if not hundreds, of these companies in these sectors, that will give us a product that again is commercially viable and really solves our greenhouse gas issues. So we have waste to value. I've told you geothermal is emerging for us. In our baseload power category, we have 2 nuclear companies that, and then again, this is not exhaustive in terms of our pipeline and our diligence, but just to give you an idea. Some other really areas that are coming through are carbon capture, which we mentioned. We are favoring point source capture, which is actually capturing the CO2 from an industrial process. So it's specifically aimed at really hard to decarbonize sectors like cement, steel, glass. And there's a company called Sante that is has leading technology for point source capture. So we've done tons of work on Fonte, and there's, again, we need to do many of these. And then there's also direct air capture that you can get, take carbon from the air.
Scrub it, yeah.
And there's lots of, and if you come to Oxy, it's been Exxon, I mean, pretty much all the major energy companies have been looking for solutions there because, listen, because they want to keep doing what they're doing.
Right.
And in light of the context that, Marty discussed, and we all know is happening in the world, it's like we don't have enough resources.
Yeah.
And that's where I start with my journey is like, well, we never did it. S&Ds on commodities. And, when they're dear, prices go up and they're dear and population is going one way. It's just increasing, so if we have to think wisely about what we have to come up with all these alternatives, but we have to keep using what we have. We have to transition it, and I believe, it's not that I believe it's happening, so.
We partner with some big chemical companies too, and they like the PR and they like everything.
Yep.
And I think they're transitioning, but very slow.
Yep.
So,
What's interesting, so the chemical companies that we have, the 3 or 4 that are already working with Braven, and then Braven has, a bunch of peers, and they are really working on it very hard. And listen, plastics isn't going away either.
Right.
Like
it's everywhere, it's oil, yeah.
it's the thing again, because it's the difference between the developed world and the emerging world, like in all these categories. It's like, well, okay, well, people need to eat, people need energy, people need, to transport things. So, it's impossible to say, I'm sorry, you can't do that anymore, because there's all kinds, we very much focus on the E of the ESG, but we're looking at the social and governance piece just as hard as the E. And while I have that just brought up ESG, again, environmental piece, we're looking through the entire, almost like the circularity of the investment and the carbon life cycle. And in the S and the G, we also look at the companies that we invest in. We look at the kind of makeup of the management team, and we look at the board. And if there's no diverse on their management team or board, we will go in, and what's great as growth equity, they always need to hire people. So like, why don't you hire some diverse people? So I actually, it's a very natural way to kind of help that trend as well. Right.
Sure, Caroline, I happen to sit down in your seat, and I promise I wasn't looking at your notes for homework purposes. However, there was a word that struck me, nuclear, and you mentioned it.
Yep.
So what issue, I mean, there's a big debate in the world around nuclear issues, I suspect, and maybe Europe is much more ahead of us than that. Can you give us a flavor of, that's an opportunity, right? I mean, that's a huge, and you kind of start, there's kind of issues around interpretation, regulations, etc. Europe's ahead of us compared here. Where are we at?
It's mostly regulatory. That's our issue, and and there has been, you mentioned already, so the companies that we have on our pipeline wheel are ones that we've done our work on. They have modular construction. They have de-risked nuclear significantly. The technology still is like, because we are looking at like, well, is it going to be 3 years to the demo plant, or like, do they have a demo plant? Is it going to be 10 years? And that's how we're thinking about the cadence of our investments, is prioritizing what would have a demo and commercial viability and some revenue earlier. But that doesn't mean, again, that isn't viable in a 10-year frame or a 15-year frame. And nuclear is what we're dogged with in the United States, is this all of our state by state regulation. Utilities are regulated. So you have to go. Everything has to be done. There's not a national agenda, whereas other countries.
Well, it's kind of like the healthcare, I mean, regulatory arbitrage. Where's the regulatory arbitrage overseas in Europe and other parts where that could be a huge piece of the global component versus what we're hamstrung in the States here?
Well, that's a great point, because the impact that you're getting from these investments it's like, it doesn't matter if it's a facilities in France or Germany, so it doesn't necessarily have to actually be deployed in the US. The US has those opportunities. We need more battery manufacturing here. We need every supply chain component built in America. All the steel manufacturing is in China. To Mary's point of governments we get along with, we don't get along with any folks. And there's also job creation in the US. But point being is that it's a great investment in nuclear, and that it's getting deployed in Canada more. They're mobilizing around it. That's where a couple of our companies are based, and in Europe and Asia. And so it's almost like it doesn't matter. The good news is the technology companies are all based in North America. So we get the benefit of de-risking, the opportunity that
Right.
you don't have to worry about the jurisdictions and things.
Okay.
And the actors or the people that will help do the projects or maybe corporations that are very used to like doing business in these jurisdictions, most of the energy companies, even consumer goods companies, they're like, oh yeah, we're in Ghana, like we can do that, like that waste project, no problem. So that's a great way to leverage it. And we've been able to say we can focus on North America because there's so much innovation that's here. So I think that answers the question about we focus on American companies.
But the nuclear side was always the waste. Remember all the debate about the Yucca Mountain, I think, in Arizona? They were gonna put it there. I think they decided just to keep it at the plants. The problem now, it's become a national security issue with all the terrorists, Indian Point's in Westchester.
Yeah.
So.
I love that
And
you
they-
brought it, you point out that.
And they've been decommissioning that for a long time.
Same with
Yeah, yeah,
Hanford and Oregon.
yeah, yeah.
But the
Doesn't take
nuclear
much.
power it's a policy issue as well, right? Because they decided not to process it all the way and not create enriched uranium, right? Because otherwise, what you'd have in Yucca Mountain would be 10% of what you actually have, right? So that was a Jimmy Carter decision.
Yeah, I think the reason why it's getting a lot of support, I mean, it is jobs, a lot of money, high paying jobs, high technology, obviously. But it's also the whole climate change, and India Point was, when I was 20 years ago at Con Edison, 10,000 megawatt base load in the summer, and 1,000 megawatts is coming in from Indian Point. If you want to turn on Enron days, you want to turn on the gas turbines in New York, you got all the carbon pollution, you got all the issues. It was a mess.
And to that point, so we have reliability issues everywhere. And again, we just don't have enough.
Right.
In the summer we'll have brownouts. Here in California, too much renewables on the grid, and it's like, and we need gas, and we still need gas because we're not upgrading the grid. That's an area that we look at Pana. We need energy storage, we need grid stability. So that's and it's deployable, it's commercial, and we just need more.
California is getting sued for all the wildfires. It's the utilities starting. Yeah, it's crazy.
So California produces 15% energy, 15% less energy today than it did in 1995.
How many more people
All
out there?
the stuff they brought online.
Yeah.
And actually, all of the renewable energy that they brought online does not replace the hydro that they've lost.
And they're about to turn off their nuclear plant, right?
Have you looked into fusion
there's
energy?
a couple.
Yes. So
So
the
fusion-
It's remarkable.
ones that we didn't mention yet. So
Yeah.
we have several. We have looked at Commonwealth, and there's another big one which I'll get back to you on.
TAE, TAE,
Yes,
yeah, out of California.
Yeah.
I know those people.
and
It's amazing what they're doing.
like
What is it?
amazing
Is that the,
fusion.
Is
Soul-
the taboo,
soul mines?
no, fusion, the taboo, that's always been a
The
taboo,
fusion.
that cold fusion, like in the movies,
Oh,
like in the
okay.
James Bond movie,
yeah,
it's real today.
okay.
And they've raised over $2-3 billion in investing in this company, and that's really energy out of nothing, and it's easy to transfer, the transport, easy to manage.
The fusion.
And that's exactly it. And the other one we didn't mention is hydrogen, which is a
Right.
huge area. And so what we have at Pan, so we have like this wheel, but we also have a timeline that we just have the next 30 years, and we kind of have, it's not super granular yet because we need more capital to kind of do some more research, but just where these things sit. And so that, as an investor, you can pick your spot, and that's a lot of where the families are coming from. I'm willing to be patient capital. I'm okay with that. It's not gonna have a demo facility for
The
5 years.
Gates Foundation puts a lot of money into this stuff.
Yeah, and I can explain. So Gates is a great, the Breakthrough Energy Ventures is an incubator for us. So that one of the groups that we work with, and because they're doing early stage and they're doing some of these technologies that won't be deployed for a while. And when they get to commercial stage, then we as kind of like, great, we'll be your exit. We'll take it to the next stage. And there are lots and lots of those venture groups that we partner with, and also just people's individual portfolios of families that have maybe incubated these companies. That's great. We're like, I'm like, thank you for doing so much of the work for us, and because our funnel, it's like it's a classic, funnel investment sourcing. It's like, Carolyn, I'm creating, and it's 30 years of me having these relationships with folks of that. They're showing us deals, they're bringing us in. If you're great, you're going to be an exit. Oh, you can just extend our capital, and we can partner them on the technology piece. especially corporations. So, it's great. Like, I just was in Nashville over the weekend. I saw another wasted out company, and Halliburton is the seed and did all of their work in Borg Warner. And I'm like, oh, I was like,
Engineering group,
yeah, I was like, awesome. So I was like, let's sit down, because we have our own engineers, but great, like, because as many smart people we can put in the room, because I guess what I will wrap up with, or I love any more questions, but this is all new. There are not a lot of exits. This is impact, so there's not a lot of track record. We're a new team. This is new stuff. Like, we started the day, which I was like, oh my God, total depression, like about the emerging manager discussion. And I was like, I'm not going to say anything because basically there's no way to fund impact in traditional asset management. What bucket is it? It's like we like to be on fund two, and it's like, wait a second, how are we going to get this going? So what I sought to do with the team, and also a track record based in what we know in energy as one area, but LNG technology, shale technology, early days renewables.
You guys are doing something that is one of the few spaces in investing that still has arbitrage.
Correct.
The reason that is difficult to make a buck investing in companies these days because everybody knows everything already.
Yes.
And you have all the information ready right here. Now, in this space, you talk about carbon credits, you're gonna make a bundle of money, and there's still arbitrage opportunity because the protocols are not set. They don't know how to calculate every company process or organization has to create a protocol to be able to calculate the carbon, to be able to go out and sell in the public market. So that's a deregulated market. Like, those are all that. Then if you talk about repurposing of materials and trash, I mean, talk about an arbitrage there. I mean, the same thing that what you mentioned now. One of the first businesses I had was treating the used oil from the ships, and they would pay us $40 a ton to treat it. They used to, and today that business they charge you 10 15 cents a gallon. So all these things that the arbitrages start to close those gaps. This is one of the only spaces, if you talk about carbon, energy, recycling, where you can actually have an arbitrage opportunity still. So I think that the space and the investment theory has a lot more beef than a regular PE fund, because you still have the arbitrage opportunity that nobody else does.
I think so. And also,
Next slide.
All right, everyone get down the checkbook. But what I will say,
It's great.
What I will say is that, I could tell you so many things, but we are delivering actual carbon credits to some of our investors. So like Glencore, are like, how about you can give us some financial return, but give us the credit so we can put against our scope 1, 2, 3.
Sure.
Because to your point, and there's a great business in software. So, I'm talking about hard tech. So this is the thing nobody wants to do. Everyone's running away. They're like, ew, like, can you just do software and services? And we do, because we have to have all the monitoring, verification, and trading. So we've seen dozens and dozens of these trading schemes. We actually invest ourselves in monitoring software so that we can deploy it to our companies. So then they can get the carbon score. So
yeah,
we're way over time. Can you talk a couple of minutes about exits? How you exit this stuff and et cetera?
Thank you, Marty. So we are very exit aware, and I actually have a slide in here about that, is because the stage that we're getting in growth, we're taking it to corporate takeout, which again, the money and the ambition is huge. It's just getting gas out of it. So we have a 10-year fund, and with 5-year investment period, we'll deploy the 150 in 2 years flat. Probably before that, but exit as well. We've shortened up our tenor of our modeling to 5 years because we're getting the corporates, we're getting IPOs, we're getting SPACs. Obviously, we have like a dozen SPACs that call us regularly about, who should we look at, because you're looking at growth stage. Your folks have some revenue, like there's a chance that they may actually make it, and that's where we need, and they desperately want sustainable companies. So, because one of the pieces I started Pana with is that, yes, I've been an energy trader and banker for so many years, but I was at Lazard last as a portfolio manager. So I ran a real assets portfolio with public companies, and I'd sit there and I'd be like, there's not enough public companies when people wanted to do sustainability screenings. I was like, So to your point, Marty, the exits are very clear. So we're modeling our to exits, obviously at inception. And we're getting very tight exits, but we can get to the 2 to 3 X's, and we can get from, we're getting into companies valuations are probably 300, 400 million, all the way up to probably 750 or so. And frankly, we're getting stretched a little, like maybe even $1 billion. I can explain one of the recent companies that we had worked with, LanzaTech, which actually recently did go SPAC. I think they'll do well, but they were like around $1 billion valuation, and then they stacked at 2.2. But
You say you think because the stock price on so many SPACs have been going down, that's a concern.
Is it as soon as they have to report earnings or
Yeah.
and
Yeah, but
things get
if the company is good, the SPAC will go wrong, but not the company.
should be
So
right.
there will be a management buyback or something like that, and you just, you refund it again because the fundamentals are there.
Correct, and which is where I heard a lot about distress and about 50% of all battery companies fail, but the IP then gets sold, like we just talk about that darn straight. And we're looking at all of that, like as Canada, we're like, oh boy, and listen, we don't love it if the company's been on like their 4th management team, but like it kind of happens, like we're at the early innings of like restructuring, and when I explain to friends, I'm like, well, just it's hard, like people don't want to do things for the first time, they want to see a business, and even if it fails, so like they can go in and they can restructure it, that so there's distress opportunities, credit opportunities. This is like right, we do have some of that already, but and we're conscious of it, but the value remains because the technology and the process is not just a straight up patent. We talk about the process, all of that, the ecosystem around it.
No. I was going to say, who else is doing what you're doing?
So there are more people that want to deploy credit into projects. So there are people who look at our space and not with the same lens with the large scale greenhouse gas reduction, but with like a sustainable lens. So they'll look at some of the companies that we're looking at waste to value, definitely battery technology, but they want to play in a different part of the cap stack. They want to play in the de-risk part of the cap stack.
Right.
So they're getting less returns, they're getting more like 15%, 20%, but that's still pretty good. So we don't have as many groups doing equity. And the reason that we chose growth equity, because we get a seat at the table with these companies where we get to be a significant owner. We get to sit down, be instrumental in bringing in corporations that could help them de-risk, good partners, helping with the revenue model. Like basically like, okay, Braven, you have to build 100 units. Like, should you raise all the money in a build and operate model and you go out and do it? You don't really have any experience doing that. Like, so either you bring in a corporate partner, or you also de-risk it. Maybe you do some licensing and royalties. Like you'll build some units, deploy them into a chemical company that use their back end, get some revenue in the door. So there's very much smarter ways, which are basically been shown with solar and wind and early stage energy, metals and mining that work, that you can accelerate the timeline to larger projects and brings in more revenue earlier, so that investors go, oh, this stuff does make money, oh, it comes in on time, because I get it, I've heard, for the last 20 years, like, and as recently as, like every other week is, this doesn't work, so anyway, so that's part of being a value added investor and the growth equity piece.
All these deals are too large to be Reg A plus or something like that, correct?
Too big?
Yes.
What's the minimum for that?
I think Reg A plus is 75 million is the max you can get. So probably if you're exiting at $1 billion, it's way too big for a Reg A plus.
It's too big.
Yeah.
I mean, and I should mention last thing is that, so the reason we chose $150 million for a first fund is not because that's all the pipeline we have. We probably have 10 times that. It's just we could close it in a reasonable amount of time. We need to get the exits going so we can prove the thesis, because it's really important, because we're just lacking this product in the market. Because we have another, vein of just, I think retail investors, younger investors, millennials, like whatever, they want to have things that, represent, their values. But so we have the 150. So we could probably, deploy 10 to $30 million checks to 6 or 7 companies, and then we'll have we have a co-invest program, so we can upsize, so we could have, 50 million, 100, because we want to take institutional checks of, 100, 200, and so we're just starting, so give us a little money in the fund, we can do the bigger co-invest. Fund 2 will be, multiples of Fund 1, but I don't want to get ahead of
So
ourselves.
Fund 1 is closed, you raised all the money?
No, we are not.
How
No,
far are you into it?
we are making our first close at the end of June of $50 million. And then we'll make the last close by the end of the year.